Hi, welcome to Christensen Wealth Management. I'm Michael Christensen. Thank you for taking time out of your day to watch this weekly stock market update for the week ending Friday, September 21st, 2018. Before I jump into the charts and commentary, I would like to begin with the quote of the week. And this week's quote is from William Bruce Cameron. He is an author, columnist, and humorist who wrote the book A Dog's Purpose, which is also a very excellent movie, especially for those of us who have dogs. I recommend it. William Bruce Cameron once said, "Not everything that can be counted counts, and not everything that counts can be counted." Those are some wise words from William Bruce Cameron. Well, real quick, this past week I participated in a Prostate Cancer Foundation golf tournament that I helped start 8 years ago now. I was inspired by my dad's diagnosis with prostate cancer to start something to lift his spirits, and put together 42 golfers 8 years ago. That has now grown to 148 golfers. Men, get checked. Get your PSA levels checked when you do your blood testing every year for your doctor's physical. And women, please tell your men to get checked, because men are often too proud to get checked, but we also don't complain about pain until it's often too late. Getting on with the stock markets. The U.S. market has been pretty much just kind of back and forth the last 2 weeks with a slightly upward bias. There is a Federal Reserve meeting next week on Tuesday and Wednesday that could create some volatility. Everybody thinks they're going to raise interest rates again, and we'll see if they do. But the dollar has been falling, which is interesting, and that may be having some effect on emerging markets and the international markets, because over the last week or so, emerging markets appear to be finding a little bit of strength after getting beaten up severely for 6 months. And the European stock indexes have also been taking a pretty good beating and are showing some signs of life. On a separate note, I did see a couple days ago that Japan has now exploded to the upside in their Nikkei index, which is interesting. I haven't had enough time to dig into why that is happening, but there is stuff going on around the world, and we are entering the most volatile time of the year for the stock market. So we need to be vigilant and pay attention, and I'll be watching these things for you, and I'll let you know if there's anything you need to know. Let's go ahead and jump into those charts, beginning with the Dow Jones Industrial Average. Looking at this Dow Jones Industrial Average chart from November 1st of 2017 until today, you can see the big drop we had at the end of January, starting on January 26th, and the summer and spring choppy markets that we had that put in a recent bottom on June 27th and resulted in the beginning of this race to the top again. And we're coming up here with lighter volume, which is interesting. We'll see if the Dow can continue this rise upward. But right now it's putting the charts into a very strong pattern. We've got the short-term indicators, the 5-day moving average above the 20-day moving average in blue, indicating short-term strength. And the blue 20-day moving average is above the purple 50-day moving average, indicating intermediate term strength as well. So right now there is blue sky overhead for the Dow Jones Industrial Average. Looking at this chart of the S&P 500, you can see that the uptrend has continued, and we have much of the same strength that the Dow Jones has. If we turn on the 5-day moving average in red, you can see that it is above the 20-day moving average in blue, indicating short-term strength. And if I compare that with the 50-day moving average, you can see that the 20-day moving average in blue is above the purple 50-day moving average, indicating intermediate term strength as well. So the S&P 500 continues to push higher with short and intermediate term strength. However, the volume of shares traded is much lighter, or somewhat lighter, than it was back on January 26th. So we broke to new all-time highs, and we've sustained those all-time highs with lighter trading volumes. So whether or not that is bearish is yet to be determined, but we have not moved to higher price with more strength in trading. So we'll keep an eye on this market to see what it chooses to do. If I take a look at the bearish pattern that may be unfolding and connect these highs here for you, let's go ahead and connect the tops, and I'll change this over to a candlestick chart like the other one, and you can see that we connect those highs just like that, and we'll connect the lows from June 28th, and you can see that they line up pretty closely with each other, and that could be a bearish rising wedge pattern as well. So the pattern is converging. It's getting narrower and narrower as we're getting higher with the light volume, and we're coming into the seasonally volatile time of the year. So I'm going to keep a close eye on the S&P 500 and see if this does turn into a bearish pattern. But right now it is showing strength in the short and intermediate term time frames. Here is a chart of the Nasdaq 100 stock index, and up till now it has been the strongest index of the three. It's full of the big technology stocks that have been responsible for so much of this market's growth over the last few months and years. But right now the Nasdaq may be the first one to begin its downward trajectory, which is interesting. Some of those big name tech stocks have in fact begun to turn lower with conviction. So let's take a look at the short-term indicators. You can see that very slightly the 5-day moving average is just a little bit below the 20-day moving average. So I guess we'll technically say that the short-term indicator is showing a little bit of weakness, but they're almost right on top of each other there. So we need a little more follow-through to get some clear picture there. And if I turn on the intermediate term indicators, the 20-day moving average in blue is above the 50-day moving average in purple. And you can see that this Nasdaq has been bouncing off that 50-day moving average once right here on June 27th, bounced off it here July 30th, and has bounced off it right here as of September 17th. So I'll be watching that very carefully, but I will switch this over to a candlestick chart and show you something very interesting as well. And that is the potential breakdown of this index. If you connect the lows just like that, you can see that the low of April 4th touches the low of April 24th and 25th, and May 3rd, June 28th, July 2nd, July 30th, and we actually broke that trend line on September 7th. Thought we were going to get back up there, rallied last week, and then yesterday, which is Monday, September 16th, we broke that trend line again with conviction, tried to rally up and get back above it one more time on September 17th, and failed and pulled back below the line. So as of right now, the Nasdaq 100 is potentially the first index to I do not want to use the word failed, but is showing the most weakness because it's breaking down and looks like it may want to go lower. So I'm going to be keeping a careful eye on this Nasdaq because it is so dependent on those big technology stocks. So caution is warranted on the Nasdaq 100. It's been a nice uptrend for this index, but it is an extremely volatile index and can fall quickly. Once again, here is my favorite industry sector of the week. That is the S&P 500 Consumer Staples Stock Index. This dropped 17.3% from its high on January 26th to its low of May 2nd. Rallied sideways for a month. Broke out the early second week of June, as represented by the yellow oval here, and once we broke out of that declining trend line, this upper red line, you can see the consumer staples has just gone and gone and gone, and it has just been a beautiful trend, and that is what investors look for. So right now, consumer staples is looking very good. There's nothing else to be said about that. It speaks for itself. And here's my second favorite industry sector of the week, the S&P 500 Telecommunications Services Index. And I've been watching this and commenting on it for several weeks now. You can see the high that was made on December 28th, followed by a false breakout. It thought it was going to go higher. It did go higher, but then it collapsed on itself. And then for the next 6 months, it was just a downtrend. We have the first touch here and the second touch there. Another false breakout early June, another drop, and then we finally broke it with conviction on June 27th. And rallied up, came back down, tested that red line, the declining trend, one last time, and then boom, off it goes. Took off like a little rocket. Telecom has been doing very well, and it is about to, let's see, looks like it made almost about to make a new high for the last 6 months. So I'm going to be keeping a close eye on it. But right now, Telecom is looking very good. Thanks again for watching. Before you go, please do me a favor and click the subscribe button on this YouTube channel, and then click the little bell next to it so you'll be notified whenever additional videos are posted. And in the top right-hand corner of christensenwealth.com and in the bottom of this YouTube video in the summary description, you will find links to the Facebook, LinkedIn, and Twitter pages for Christensen Wealth Management. Please do me a favor and click the like or follow button while you are there. That way I can communicate with you throughout the week on social media and once a week by using these videos. Well, have a great day and a great week, and I look forward to seeing you again in about another 7 days. Bye-bye.